So let me start just by giving an overview of our food and refreshment category and talk a little bit about the rationale for why we believe it is such a good idea at this time to put the two categories together, which is obviously something that you heard us announce coming out of the strategic review in April. We have a 20 billion euro food and refreshment business. That actually puts us within the top 7 peer companies in the world. We've got a phenomenal portfolio of categories, the largest of which is ice cream, which is 34% of the total, 25%, so around 6 billion of it is in the savory category, and about 15% of the business comes from each of dressings and from tea. By putting the businesses together, and you can imagine that there are a lot of similarities when we're talking about food and refreshment, particularly as far as things like consumer trends are concerned, then we're able to more dynamically allocate our resources across categories. The biggest single cluster for both food and refreshment is Europe. And by putting our businesses in Rotterdam, adjacent with our European business, we can obviously have stronger integration and synergies. And also, very importantly, we've got a very strong food service business, our Unilever Food Solutions business that is already in Rotterdam and that we will be co-located with. And I'm going to talk a little bit later on more about our UFS, Unilever Food Solutions business. You probably also know that we are in the process, in fact, we have already started to break ground on what we believe will be a truly world-class R&D facility co-located on the campus of Wageningen University. And I know that I've got quite a US-centric audience today, but I will tell you that Wageningen University is considered to be the world #1 academic institution when it comes to agri-technology now as well. So that's a very exciting opportunity. But just some of the key reasons why it makes sense not only to put these businesses together, but to be co-located in the Netherlands as well. We also said in April in the strategic review that we saw the opportunity through integration to be able to have a very distinct operating model for the foods business at a re-engineered cost base. Basically one that says it's going to be aligned with what it needs to be able to do as a food and refreshment company, and at the same time take the benefits of scale and of the corporate capabilities of Unilever. So working on 20% lower overheads than we did in 2016, as well as leveraging programs such as 5S and ZBB to get to a 21% operating margin in 2020. This is a business that importantly has got a very strong emerging markets footprint. So 46% of this business is in emerging markets. Now that might sound lower. It is lower than the numbers that both Alan and Nitin have been talking about today. But I think you'll find that if you benchmark that against a peer group of food and refreshment businesses, this is an extremely strong number indeed. And both Kevin and I will be talking more about that as we go through the presentation. This is also a phenomenal portfolio of brands. You've heard a lot today about the themes of global and local. And again, in food and refreshment, we have what we believe is a true powerhouse stable of brands. We've got 5 brands which are global and are over 1 billion euro. And then we have got a stable of truly iconic local jewels. And you'll see again shortly how some of those are brought to life. Some of you who were part of the investor relations event that we had 2 years ago in Southeast Asia will know, for example, the Bango brand and what a phenomenal local icon that is in the Indonesian market. But I could say the same about Kisan in India or about the Robertson's brand in South Africa, just to name a couple. This portfolio provides us, importantly also, with leadership in ice cream, in mayonnaise, in savory, and in tea. We've designed the new food and refreshment organization, The leadership is announced, and it'll be in the very capable hands of Nitin. But not only has Nitin been announced, but the top team to run food and refreshment has also been announced. We are on track as far as the process of the divestiture of our spreads business is concerned, again, that we announced coming out of the strategic review. And we're also all set to start relocating our food and refreshment teams into the Netherlands starting in January, with the intent to be complete with that process by August of 2018. So let me shift now to talk specifically about foods. And those of you who have heard me present before have heard me talk about what it is that we are trying to do in foods. And that is to serve our purpose of food that tastes good, does good, and doesn't cost the earth. We have a much more focused and arguably much more competitive foods business than we had. And so if we could just go back for a moment to 2008, we had a foods business that was actually bigger than the business that we have today. It was 14.8 billion compared to the 12.5 billion that we have. But it's also a portfolio where we have divested 2.9 billion worth of turnover, a lot of it actually in this marketplace in the US, because it wasn't aligned with the portfolio that we believed that we needed to have for the future. And I know that Case will be touching a little bit on that tomorrow, but I think you can see in the pie chart that where the big change in that has come is that we have now focused the business very much against our core categories of savory, dressings, and spreads. And that other part that was 16% of the business in 2008 was only 6% of the portfolio in 2016. This was a business that was also, for legacy reasons as far as our portfolio, but also I think because of the nature of packaged foods and the development of packaged foods globally beyond just our categories, that was very developed markets focused. So again, wind back to 2008, 30% of the business was in emerging markets. If you look at where we are today, it's 44%. If you look at our top line numbers for the first 9 months of this year, 46% of our business was in emerging markets. And if you take out the spreads business out of that equation, then 50% of our turnover on the go-forward foods portfolio as of the first 9 months of this year was in emerging markets. And I will talk more about emerging markets, again, one of the big themes that we've been running through this afternoon. It's a business that's more competitive than the business that we had before. We've gained 90 bits of market share since 2014 in our savory business, and almost twice that as far as dressings is concerned over the same period. Importantly, we have delivered a step up in underlying sales growth. And those of you who followed our foods business carefully will know that in 2014 we had a business that was in decline. We turned the corner on 2015. We had a step up in 2016, delivering 2% growth overall, but very strong performances from savory and dressings. When you look at our numbers through the first 9 months of this year, then we're at 0.9% growth, so a little shy of where ideally we would have wanted to have been after that 9-month period. But again, a very important caveat is to say that if you take the spreads business out of it in the first 9 months of this year, then we were growing our portfolio at 2.2%, which against the backdrop of foods globally is a competitive performance that we've had there as well. This might look complicated. It's actually a very simple framework that we've got. I talked about what our purpose was before, but when you think that Unilever is about making sustainable living commonplace, then as a foods business, that what we are trying to do is really to make sustainable nutrition commonplace. Is all of our portfolio from a consumer perspective perfectly in the bullseye of that? I would be the first to say no. Are we shifting there? Yes. And I think that when you look at our renovation and innovation program, you can see that. And similar to the other categories that you've heard about this afternoon, we're focused on growing the core of our business. We're focused on evolving the portfolio, particularly critical for the foods business, and obviously around developing our channel footprint further. Growing the core is about continuing the growth journey that we've been on in emerging markets, but it's also about ensuring that we're renovating our core brands and products. Evolving the portfolio is about the innovation spaces that we're entering into, but it is about the portfolio and acquisitions that we've had. You'll have noted that we have had the first 2 acquisitions in the foods category since 2009, and I'll touch on those shortly. And then I'll talk more about developing channels. And obviously all of that underpinned by the work that we are doing to drive savings with 5S and ZBB, and obviously enabled by what we believe will be a world-class food and refreshment organization in terms of the capabilities that it will have to drive this portfolio. So growing the core, and this really starts with what it is that we're doing in emerging markets. If you look at the period 2014 to 2016, we've grown our emerging markets foods business at over 7% CAGR. It's just a little shy of that for the first 9 months of this year, and just over 6%. We talk a lot about global, but I think this really matters when you look at the fact that within our portfolio, about half of it is in the global brands of Knorr and Hellmann's, and 50% of it is coming from these truly iconic local brands. And very much enabled by the very deep Unilever route to market capabilities that we have in the emerging markets, and by the fact, as again you've heard several times already this afternoon, by the fact that we have got teams in market that are fully empowered to make the right decisions for their local markets so that we're attuned to consumer insights, and importantly, obviously in this category, to particular consumer food tastes, cultures, preferences, etc. There are also teams that are truly connected to our global teams as well. And so in that way, we really bring the best of our global scale and insight to bear together with the best of our local intimacy as well. I could probably talk all day about the capabilities that we have and the strategy that we have in emerging markets, but I thought that one way to bring this to life would be just to give you a snapshot of one market, and I'm going to focus on Turkey because I think it's a great case study of where we have been able to both renovate the core and ensure that it continues to be relevant for consumers, and at the same time to pioneer new categories in emerging markets. So about this time last year, we relaunched our bouillon cubes, absolutely the heart, as you know, of the Knorr brand. And remember, the Knorr brand is a brand that is almost 180 years old, and I think a great example of how you can continue, even as an old brand, to be very relevant in today's food environment, and where we have been able to gain market share considerably over the last year. And at the same time, we have launched a new format for that market of ready-to-heat soup. So I've got 2 films back to back just to try to bring to life how we're actually doing this in Turkey. Let's take a look. We have sound, please.
Her günde, her mevsimde, her mutfakta, her elde, 4 bucakta, çeşit çeşit ocakta. Pilavlarda, çorbalarda, türlü türlü tabaklarda. Yani her gün milyonlarca yemeğin kalbinde Knorr bulyon var. Yenilenen Knorr bulyon. Lezzetin kalbinde yine o var. Hadi herkes sofraya.
Knorr'un yeni sıvı çorbalarının lezzetini biz çoktan denedik. Şimdi sıra sizde. Ayşe Hanım, kremalı 3 mantar çorbanız.
Bon appétit, madame.
Ayşe Hanım,
Aa,
Yeni Knorr sıvı çorbayı nasıl buldunuz?
biraz daha alabilir miyim?
Tabii ki. Siz bunu incelerken ben bir tane daha getireyim.
Dünya mutfağından özel malzemeler ve gurme tariflerle yeni Knorr sıvı çorba serisi. Lezzeti alır götürür sizi.
So an emerging market, global and local, working together on that, growing the core and expanding the portfolio into new segments for that market. And we have been growing our business in Turkey by just shy of 20% in the first 9 months of the year. So hopefully that just gives you a sense of how we look at the business. Now, if we shift to looking at how we evolve the portfolio, and that obviously is the name of the game when it comes to developed markets in particular. You know, I think that food has never been as exciting as it is now. You can probably say that I'm biased in that. But I think that if you talk to millennials, you see that millennials actually Instagram and they tweet their food before they've even eaten it, but never have we had as involved a food generation as we do now. And although you get one particular read of food when you look at it at a macro level, actually when you look at sort of the granularity of growth and dig into that, there are many segments of the foods markets which are growing. And they're obviously ones that I suspect that many of you as consumers are participating in. So areas like all natural, plant-based eating, vegan, consumers looking for more conscious snacking options that they have, the traditional meal fragmenting and it being very much about smaller eating occasions, many of them on the go, etc. And then the rise of particularly dietary preferences, gluten-free, obviously extending well beyond the population that is truly gluten insensitive or allergic, dairy-free, lactose-free, etc. So all of these offer us enormous opportunities to be on trend with consumers so that we can serve their needs better. And that is very much where we're focused as far as both our global brands and our local brands are concerned. But if you look at what we've been doing over the last 2 years, we've introduced 100% natural lines within Knorr. We have a portfolio of organic products under the Knorr brand as well as snacking options. And just to dimensionalize that a little bit more, you can see some of our most recent introductions. You can see actually the third one from the right on the top line, a new line of meal starters that we are launching at the moment in the US market, some fantastic tasting products based on ancient grains, so again, very much on trend. We have a premium line of side dishes that we also launched in the US market earlier on this year, 100% natural, also gluten-free. And you can see on the bottom some of the other innovations that we have. So I hope you'll agree, quite a different looking Knorr to the Knorr brand that we had. And important to note, and again, for a brand that, as I mentioned, is 180 years old, a brand that has been growing at 4% for us. And similarly, if we look at the Hellmann's business, you can also see an old brand that dates back to 1912, that is very much part of contemporary eating, where we've been expanding into other condiments. And you can see in the ad on the right-hand side, our new ketchup launch in the UK, which is sweetened with honey instead of with sugar. And we've also got a variant that is really true to our Unilever Sustainable Living Plan in using the whole crop of tomatoes and having both red and green tomatoes in the product as well. So just a sense of what we're doing, and this is a business that has gained more than 150 bips of market share since 2014. Connected for Growth has really enabled us to operate with far greater speed as a result of the simplification of decision rights, of being very clear, exactly as Nitin said, for his category, about that which can be done locally needs to be done locally, and only that which can uniquely be done at a global level is done at a global level. And I could have also put up hundreds of examples of where we have been beating our own records as far as getting products from inception to launch. And so we're measuring this actually much more in terms of weeks than months, but just some of the ones that I would showcase, Liquid bouillon launched in Europe in less than 6 months. Spices launched into Central and Eastern Europe in a similar time frame. We've got very flexible models that we're working with. So we have entered into a licensing model for chilled for all of our key brands in the Netherlands, just as one example. But it's not only about speed, it is also about being able to operate with scale. And that's why I wanted to talk about the relaunch of Hellmann's globally, because at least in recent years, I can't find any examples where we were able to launch in foods innovation into 28 markets in 1 year as well. And that is, again, the power of Connected for Growth. Not only that we're able to go fast because we're doing things for single countries and making all the decisions there, but because we have got connected brand communities, and you'll hear more about this tomorrow as well. We have teams that are co-developing mixes with the global team, being able to take the best practice and roll those through the brand communities extremely fast as well. We've talked also today about building brand love in a connected world. You've heard us talk before about the fact that our sustainable living brands are growing faster than the average of our total portfolio. And both Knorr and Hellmann's are sustainable living brands. Knorr very clear about its purpose, about people deserving good food. But Hellmann's, as part of the relaunch, also very clear with a perspective of being on the side of good food. So let's just take a quick look at this example from Hellmann's that gives our point of view on foods.
We care about using free-range eggs. And we care about amazing taste. Because at Hellmann's, we're on the side of food.
It's interesting, you might not have thought about this a lot before, but free-range eggs requires a transformation of the food system, and we are one of the largest users of eggs in the US for Hellmann's, and so we have driven system-wide transformation to be able to bring free-range, and actually did it in 1 year less than the original timeline that we had. So again, I think an example of us really living the Unilever Sustainable Living Plan, because we know that also matters deeply to our consumers. We're strengthening our talent and capabilities when it comes to digital so that our brands can truly dialogue with consumers, with citizens in a connected world. You'll see more of that tomorrow in terms of some of the specific studio capabilities that we have and our people data centers. We're very much around mobile first thinking. I know that last year I showed our Love at First Taste work from Knorr that generated more than 100 million views, all in digital, most of it in mobile, and there's a lot of experimentation that we have currently on mobile running as well. Evolving the portfolio, and I did talk very briefly about this earlier on. Sir Kensington's a condiments business, US-based, that we announced in April. Important addition to our portfolio, very complementary to the portfolio that we've already got, but able to tap into some of the spaces that we didn't believe that we could get to with the Hellmann's brand. And then a brand that you may know less about, My Terra, that means literally in Portuguese, Mother Earth, that we announced in October. This is a business that's very much around organic, all natural, non-GMO, brand that represents or respects rather the biodiversity of Brazil, and a brand that's very much about taste and love. So we're excited to have these in the portfolio, to be able to grow these businesses with their founders, and equally to bring the insights and the capabilities from them into the core of our foods category. I talked on the strategy chart about the importance of developing our channel footprint. That's obviously about driving e-commerce, but it's also about leveraging the great expertise that we've got in food service. And this is a business that we haven't talked, I recognize, a lot to you about in the past. It's about $2.5 billion of turnover. It's a business that has been growing consistently in 2014-2016 period at 5% USG. We've got expertise as far as really helping chefs, as we say, to do what they love to do. We do that through products. We also do it through inspiration and training. This is a business where we are digitalizing it very fast to be able to serve better the needs of our operators. But it's also a business where not only do we get insights from what is happening in food service, where typically food trends start, but also where we recognize the opportunity to build our brands more seamlessly across channels, because obviously none of us make the distinction between what is it that we're eating in restaurants and that's on a tabletop versus what is it that we have in our refrigerators at home. So a tremendous asset that we believe that we already have within our portfolio. So to wrap up on food, we believe that what we're demonstrating is a category that is showing more growth. It's a business that is driving that growth from emerging markets, but also from renovating and innovating into on-trend spaces from the core, as well as a business that is changing the portfolio from acquisitions. It has done it through disposals, and obviously you've heard our intent on spreads, and also a business that is facing very much into growing channels. And importantly, given the aspiration that we have and the commitment that we made out of the strategic review as far as the underlying operating margin of the business is concerned, where we're driving a lower cost base so that we're able to put money back into the reinvestment behind our brands and capabilities, as well as to expand the margin. So with that, I'm going to hand it over to Kevin and then be back up for questions after that. Kevin, over to you.
Thanks, Amanda. So good afternoon, everyone. I'm Kevin Havelock. I'm president of the Refreshment business. I'd probably like to leave you with three messages today at the end. One, we have a strong growth refreshment business, and the growth is strengthening with a good step up, a strong step up in cash contribution. The second is that we've reshaped our complete portfolio so that we are very much in the trend spaces, both through new launches and also through acquisitions. And third, we're driving our growth into new channels in particular, with more than half of our growth coming out of new channels, not the traditional channels of supermarkets. If we look at the growth, 14 to 16, 4.2% growth ahead of our markets and ahead of food and beverage companies generally. Step up to 5.1% in the first 9 months of this year. What I'm pleased with, and you see that on the right, it's about continuing very strong growth of our ice cream business ahead of markets, but a step up in tea. We've doubled our tea growth, and we've now had 6 strong quarters of tea growth above 4%. If I take that ice cream number this year, what's also important to reflect, it's actually slightly different than most years. We had a very tough time in the US. We had a big competitive challenge from a brand called Havelock. We've actually fought back well, but we actually declined 2% in the US. But we had such strong plans. We've had double-digit growth across our D&E markets and a 4th year of strong growth on ice cream in Europe, which has allowed us to grow at 5.6%. These growth rates are sort of compared with, I think you'll know many of the mainstream food and beverage companies, the better ones growing at 2 to 3%, and some actually in decline in the first 9 months of this year. We'd called out 4 years ago our need to step up our cash contribution, in particularly from ice cream. It's a big part of our business, a significant turnover. We've now got to nearly 17% return on invested capital on ice cream. Again, that's ahead of the average of most food and beverage companies. And as you might guess, with the strong results of this year, that will be developing further. We've doubled our cash flow since 2014, and we've tripled it since 2012. and it's been the most significant cash contributor to the growth of cash for Unilever. How have we done that? That has been about C4G, ZBB, but most importantly, sweating our assets really strongly across the world. And that's one of the reasons why we were also very focused on getting to cash through premiumizing margins and through growth. Because growth is very, very important on an end-to-end business like ice cream with the use of capital in factories, in trucks, and in cabinets. So sweating the assets has been key to that. Over this last 8 years, what we've been doing is gaining and growing market share across the world of the broad ice cream business. We've increased our share each year. The number 2 competitor lost share each year, and as you know, last year they decided to throw in the towel on their own and actually combined with the number 3 in the market. So that was Nestlé came together with R&R to create Sourry. It's worth noting, of course, that our market share gap versus the number 2 and 3 together is much bigger than the gap that we had versus just the number 2 back in 2008. And I believe absolutely strongly with the portfolio of brands and repeatable models that we have, we will continue to grow and succeed in ice cream in the future against the new competitor. We needed to reset our tea portfolio. Although you can see top left here that we're nearly 3 times the next biggest player in the market, leading on with the Lipton and the Brooke Bond brands being the 2 biggest in the world. Having said that, we had a portfolio that was somewhat stuck in mainstream, which was growing at around 1%. And that was a problem for us. And so we've spent the last few years reshaping that business, and I'll talk about that. I'd like to mention ready-to-drink tea. We have a joint venture partnership with Pepsi. Our ready-to-drink business has been growing with Pepsi together about 7% each year over the past 3 or 4 years, so one of the fastest growers you can see across the world. It's a 50-50 joint venture partnership. Of course, with that, that's also been delivering profit. You don't see that in the underlying operating margin of Refreshment, but of course that does contribute overall to our earnings. Accelerating core portfolio, we've been growing the core of our portfolio. It started with Lipton Yellow. Lipton Yellow has stepped up this year. It's $1 billion in itself within Lipton. What we've been doing is putting value brands just in below Lipton so that it doesn't get dragged down. And we have great clarity now on where Lipton can operate and win. And what we're finding is, first, coming from black tea, green tea is an area we've been able to grow and win, and we've taken leadership outside of North Asia. And also benefit teas, and we've been bringing benefit teas to the market, such as, for example, the benefits you get from matcha from North Asia. But we also knew we could not do enough with just Lipton and Brooke Bond. And that's why we've reshaped with new brand launches and with acquisitions. In North and South Asia, we launched Sir Thomas Lipton and Taj Mahal. We launched the Pure Leaf brand that we'd been growing in ready-to-drink. We've now launched it across 12 of the developed markets in leaf tea. And we acquired, of course, Pukka Tazo T2, and I'll come back to those. This is our refreshment strategy house. I mean, basically, we are about making feel good across the world. Feel good, why? It's about bringing people together over a cup of tea to have a chat, friends, family, etc. And for ice cream, also bringing people together, particularly parents with their children. There are 3 areas I'd like to touch on. We've been about growing the core, evolving this portfolio, and developing the new channels. Let's just talk about the trends and how we've evolved the portfolio on the trends. There are 5 big trends that have been impacting our markets and many food and beverage markets. The first is people up-trading to brands where they want superior sensations and they're prepared to pay more for them. And with that, we've driven into it. Magnum is probably the best example. With Magnum Double, big success in 2016, again in 17. We're seeing over 15% growth on the Magnum brand. So if you go back to that earlier chart, Magnum was a $550 million brand in 2008, now $1.4 billion, and we're driving it forward with fast growth. But also, we're applying this in local areas. We have a brand called Taza in India. It's an important brand, And there we found by understanding local consumer tastes, we were able to give a better product at a lower cost and better margin. And that brand is growing 60% this year by being really, really focused, connected for growth on the local market. Pure, real and authentic. We've taken leadership position in gelato in the world. That's primarily through acquisition. We acquired Talenti in the US. We acquired Grom in Europe. We've taken now Grom into in-home. Grom was very much ice cream boutiques. We've now actually applied our skills to bring it into the in-home environment, and it's beating our expectations. And Pure Leaf I mentioned as a launch. Health and wellness, we got beaten to the mark by Halo Top in the area of low calorie and protein. It suddenly took off. It took off first at the end of Q4 16. It really took off in 17, and we didn't have an immediate answer back then. What we did do, we responded fast. In a connected for growth way, we took our leading brand in North America, Breyers. With the Breyers brands, we were in the market within 5 months with a low-calorie, high-protein version. We also responded with Ben & Jerry's, and we've been able to hold up a 6% growth rate across Ben & Jerry's in spite of the attack that we've had. And we are in good shape for next year. We have 60 new items that we've presented to the trade for next year and have a very strong response in the North American market. So by responding fast, what could have been a very serious situation for us actually landed with a 2% decline, which in the greater scheme of things is manageable, and we can then grow our way out of that. Health and wellness in tea has been at the heart of the new innovations we've been bringing. And just to mention this matcha product, on Lipton, we've taken that across 15 markets. It's a trend that's come from Japan, and we've really seen that when Lipton brings new things as the leading brand in the world, it can move into these new spaces. Fluid Lives is about people being out and about, and in ice cream, one of the things we're focused on is not only winning in ice cream, but now increasingly winning in the broader snack market, which is an even bigger market. So by doing that, we've been designing brands and products to launch into those markets. So for example, if I take the snacks that we've launched into Southeast Asia and Mexico, we've had 20% growth in that segment just by focusing on sandwiches that have unlocked the market. Ben & Jerry's has done that as well in North America and particularly successfully in Europe. The final area is the one around experiences around the product. You've heard a lot about the fact that people probably don't watch as much TV as they used to. TV still has a very important role to play for our brands, but you actually have to offer people experiences. That's why we've set up a retail operations department. We have more retail shops and kiosks across the world than any other FMCG company, many of those with Ben & Jerry's, with Grom, with T2, etc. This gives people the chance to have a real experience with our brands. If we take Magnum, the 25 leading cities in the world all get a Magnum store, and we drive it to make sure it's high on the time out list, that everyone has a chance to Instagram their experiences to all of their friends. It's very, very important that one actually engages individually with people and deeply, and that's what we're able to do with these brands through experiences. Growing the core, we talk a lot about brands with purpose. What's very important with tea is actually very intimate. It's about those situations that you have at home, with friends, with family. And across Brook Bond, we've been finding touch points that really talk to people, relevant market by market, and we've seen 3 times the growth rates when we've been able to bring this to life. Let me just give you an example of how we've done this. Red Rose, which is our Brook Bond brand in Canada.
Thanks, Dad.
I didn't know you were having a friend over.
Dad, this is Amy. She's not just a friend. She's my girlfriend.
Tell me a little bit about yourself.
This is an approach we've taken by finding relevant touch points in each market across the world. This is classic C4G for me. For example, in India, where we took market leadership in our biggest tea market in the world this year, on our biggest brand, Brooke Bond, we approached it, for example, Hindus and Muslims together, actually making bridges where there is a world that's pulling apart, and that's very, very important across the whole of tea. Lipton actually takes a similar space, but much more where Brooke Bond is about homes and families. Lipton generally is about friends and the broader environment. And here we use an idea of being awake to what really matters around you in your world. And this has also unlocked for us a double-digit, a step up of growth. Sorry, not double-digit. We've doubled our growth on Lipton. And then again, I mentioned about snacking in market development in terms of growing the core. The second thing that's been important and will continue to be important for us to keep driving this growth is having repeatable models that we're clear that we take across markets in the world. So on the one hand, with C4G, we have to be relevant to the market. On the other, it's bringing the best of our skills of where we know how to win. On tea, we have a flywheel which helped us in India. We've taken it across Pakistan and across the Middle East, which actually allows us to take every market and train them how to win decisively in tea. And in ice cream, we've been doing that for a number of years. If I take Cannes, it's an activity we've done for 6 years. It's the Cannes Film Festival. We partnered up this year, for example, with Cara Delevingne, with Moschino, with the designer, and we had 15 billion impacts across the world as we made sure that that flowed out to make sure that Magnum was a desirable brand. And then we have a DAVE program, desirability, availability, visibility and execution. In an impulse brands market, this is the way to win. And those of you that have visited, for example, Turkey in the past, will have seen how we've brought that to life. We needed new brands in our portfolio because Lipton and Brooke Bond was unable to do it. Hence, Pukka, the fastest growing organic brand in the world. It's organic, Ayurvedic, built on Indian traditions, really beautiful brand. Tazo, Lipton, again, was unable to stretch into the new growth spaces in a US environment. Tazo is a beautiful, new, exciting teas brand that, within the portfolio. T2, which brings luxury. We've doubled the T2 business since acquisition and taken it across new markets. And then finally, Pure Leaf. And let's give me an example here. This thing about pure, real, and authentic. Consumers are looking for that. And here's an example of the way that we bring that to life with the Pure Leaf brand.
Tea is something to discover. You can't be impatient. When I craft Pure Leaf iced tea, I don't take shortcuts. I fine-tune the blend according to what comes from nature. I want people to experience the same amazing taste of iced tea that I do. That's why I taste and taste until I craft a smooth, delicious iced tea. I'm Alex White, Pure Leaf Tea Master. Pure Leaf, our thing is tea.
So Alex White has brought this to life for us across all of these markets, leaf tea to RTD, to make sure we have a consistency across both. In terms of evolving the ice cream portfolio, I mentioned about the fact that we took a leadership position and have been driving hard in Italian gelato. We have the leading Italian gelato brand in Grom. We've also been driving pints. We're now at 34% of our total portfolio in premium. And this year, a big breakthrough for us was Magnum for the first time going into the pint moment, the evening moment that people consume together. It beat our expectations. It was 40% above the original plan. I'll just give you a sense of what the Magnum pints look like.
Carefully made to be broken, new from Magnum.
Given that we've recently presented it, so I would look out for this in a local store near you very soon. So that's premiumizing. The second was snacking. Along with snacking, We also see a drive towards some sort of fresh fruit-type positionings being necessary, certainly in Southeast Asia and Australia. That's why we acquired the Weiss brand, which just fills out the portfolio at that end of the world. And then in health and wellness, we've got the leading non-dairy positions across the world with Ben & Jerry's across North America. We launched a brand called Swedish Glass across Europe to take a #1 position in health and wellness. I mentioned about Breyers coming into the space of low calorie and high protein. Having seen what happened here, obviously in a Connected for Growth world, we've been able to take that now across Europe, and therefore we will be leading into Europe. We launch in 12 countries in Q1 next year. So it's important for us, we can learn in one market and make sure we move very quickly so that we don't miss out in another. At the heart of what we're doing is also, of course, a digital world. And funnily enough, ice cream becomes more relevant now that delivery times come down. It becomes more relevant for an impulse product. So apart from grocery online, I'll talk a bit about icecreamnow.com. Because if you think about it, one of the things that people say, e-commerce is all about the last mile of delivery. We have 3 million cabinets across the world that, for me, are small wholesale points that I no longer need people to come to. I can use them as wholesale points to deliver to others. And that's fundamental to where we will be going in terms of the e-com opportunity. In retail, I mentioned already, we're driving retail and growing at more than 10%. And that retail capability we're now extending across the whole of Unilever. Next year we will have 18 brands across, so not just refreshment, right across the other categories, all with retail offerings. And then we have D2C. We do direct-to-delivery from, for example, Portugal through to Brazil in areas such as parties and offices. What's important is 60% of our refreshment growth is coming outside of our traditional, our supermarket channels, because we're driving towards them. Icecreamnow.com is basically saying people are wanting and ordering at home. For example, food, they're ordering at home. So whether it's now we have a Domino's pizza partnership to make sure if people order a pizza, they can also get a Magnum or a Talenti or a Grom or a Ben & Jerry's with the product. The same with Just Eat. The same with Deliveroo. So wherever we look across the world, there are different models building, and we're making sure that we are the ice cream offering as the market leader in the world to come with those. And of course, driving up our route to market partner digital capability. So whenever our partners need product, we are immediately able to offer it to them. We've been looking to very much leverage agility and speed. With the new brands we brought in, we are getting learning across the new companies that we bring in from our own companies and sharing those learnings. And those entrepreneurs are very much still part of the business. Founder's mindset. We're looking for the fast rollouts across the world, which I talked about. And very importantly as well, because the number 2 in ice cream across the world is looking at licenses as a core part of the program. We have 70% of the licensed business across the world. We have the Mondelez brands, Oreo, from the US through Turkey, Philippines to Australia. We have the Hershey's brand with Reese's in our portfolio. We have Disney in 7 markets. We have Mars in a number of markets. We have Minions in Europe, and we've just launched Kinder. So we've just announced our partnership with the Kinder ice cream with Ferrero. So we're taking Ferrero across kids across the world. The driving of margins, it's been about premium innovation in the market. It's been about embedding the 5S program that you heard about earlier, and it's been about ZBB. That's given us 170 bips of margin improvement in the first half of the year. So as I said, for refreshment, we're in a great shape now for the next phase as we put F&R together. It's about a strong performance, an enhanced portfolio with the best portfolio to win in ice cream and tea, and an ability to transform through new channels. So as we go into F&R, finally, 20 billion business, 7th biggest globally. You heard that earlier. We have a strengthened organization with strengthening performances in both food and refreshment. We're re-engineering the cost base for the future. We've got global and a local portfolio of really strong brands, and the integration of the two is well on track. With that, I'd like to ask Amanda to come up and we will take any questions that you have. Yes, please. One at the back and then here.
In combining the foods and refreshments business, do you expect to be in a position to deliver any sort of commercial synergies by bringing the two businesses together? I think you spoke a little about sharing consumer insights, for example. Or do we think about this as being very much a cost-driven led combination? Thanks.
I'll make a couple of comments and then Amanda, you add. So I think that, first of all, actually, no, definitively there'll be some synergy opportunities for growth as well as for cost. One of those would be, if you think of the capabilities we've driven in out-of-home for example, snacking across ice cream. Snacking goes across food and ice cream together. So our out-of-home capability, and then Amanda, on her side, offers a whole restaurant capability through the food service and food solutions business, which today does run separately to the ice cream and beverages business. So there would be two examples that I would have where we get real synergy and benefit from coming together.
Yeah, I think the channels part is a big one. I think it'll be an emerging story that you'll hear as we bring the businesses together. Obviously, we felt that the time was right to do it for the reasons that I said before, but I think it's not to say that how we've been operating to this point wasn't right. You saw me talk about getting to a much more focused foods portfolio than we'd had and building a depth of capability, reigniting growth. You saw Kevin talk also about the huge amount of work that has been done to get to a different portfolio and to a different level of performance on the refreshment category as well. So it was an inflection point for us, the right time to bring them together, some obvious cost synergies, some things that we believe we will be able to tap into as far as channels on the commercial synergy point, and then I think you'll see us talk more about some of the opportunities as we get into it.
Hi, it's Jeremy Fialco at Redburn. So two questions. The first one is just on margin. Can you talk a little bit more about the building blocks of the 500 basis points of margin that you're going to deliver by 2020 beside the synergy opportunity? And then the second question is, I know in Alan's presentation he talked a lot about how the margins were already good and therefore he was going to be able to use all of his savings for reinvestment as a way of outperforming his end markets. Clearly you've got to allow a lot more of your savings to drop to the bottom line. So in that context, can you talk about what your ambitions are to outperform your end markets? Thanks.
Yeah, so let me talk about it. And in that re-engineered cost base, then there is a chunk of it that comes from a lower level of indirects or overheads attributed to the foods and refreshment organization by virtue of the fact that we're able to streamline that we've demonstrated already in terms of the leadership team that we put together. We said that will be on a lower cost base than the two categories that have been run separately. So that's an important building block that, if you like, is specific to food and refreshment. At the same time, each of the categories are well on their way as far as the 5S programs are concerned, delivering savings into the P&L for this year. So just as one of the examples we've got in foods, we've reduced the number of different formulations that we've got by 20%. And that's just one of many as we've gone systematically through the 5S program. And then we have a level of efficiency that comes from the continuation of the corporate programs that we have in place, both connected for growth flowing through, but also ZBB as we go into the second year. So I think you've got to look at it in those chunks of there's a gross margin improvement plan underway, there's a corporate program, specifically ZBB C4G, and then there's a specific F&R program that we're now in the implementation phase of.
I think if I would add to that, the opportunity to continue to drive towards premiumization of our portfolios. We see that across both foods and refreshment. We touched on it earlier, but for example, naturals, health and wellness. Each time you go into these, they actually offer new opportunities to margin up. And then if you just take the refreshment business alone, the fact we drive into new channels, as we go into those new channels, in most cases, we drive towards a higher margin as well. So that plays a significant role. I think what is important is we're very focused on growth and profit going together, and the growth can bring a lot when one is actually making sure we utilize our factories brilliantly, and it really makes a difference.
Hi, it's Warren Ackerman at SocGen. Amanda, you talked about a spreads divestiture, not any other structure, as Unilever's talked about in the past. I'm not asking you for prices or when, but can you kind of just outline what you think the portfolio looks like in terms of growth for food and refreshment once spreads has gone? And also on the margin, obviously when you sell spreads, it's going to be very dilutive on your margin, given it's making margins north of 20%. Does that 500 basis points include or exclude spreads? So it's really around kind of the timing and what it means in terms of what's left for top line and margin outlook.
So two points. To be really clear, and I'm glad that you caught me out on that. So we said disposal, and so divestiture is one of those, but not the only route, and we've been consistent on that. So thank you for the opportunity to clarify that. And then as far as the margin that we've shown, that is the margin excluding spread. So it's exactly as when we came out of the strategic review, and you know that we're now communicating our results since the second quarter, showing total food and refreshment broken down by food and refreshment as separate categories, and we're showing numbers with and without spreads, so that we're hopefully clear to all of you in our communication on that.
Thank you very much to all of you. Thanks very much. Enjoy the rest of the day. Thank you.
Thank you.